Hey everyone, welcome back to Corporate Decoder, the place where we dig through boring corporate filings so you don't have to. And boys, this Capital Bancorp report, a doozy. It's so exciting you'll probably need a triple shot of espresso just to stay awake. Maybe even a defibrillator, but seriously, we're going to break down the important stuff, so let's get started. Basically, Capital Bancorp, a bank holding company, just dropped their annual 10K report. The main takeaway is that while they made a solid chunk of change, about $31 million, that's actually down almost 14% from last year. But don't worry, there's some accounting magic to explain that, which we'll get into. Plus, they swallowed another company, Integrated Financial Holdings, which always adds a few wrinkles to the numbers. First things first, this isn't a transition report, it's an annual report, meaning it covers the whole year ending December 31, 2024. It also says they filed all the reports they were supposed to, so at least they are following the rules. They're a public company trading under the ticker CBNK on the Nasdaq. The name on the report, just to be clear, is Capital Bancorp Inc., based out of Rockville, Maryland. Now, before we get too deep, there's a whole page of legal mumbo-jumbo about forward-looking statements. Basically, they are saying, hey, we're making guesses about the future and things might change, so don't sue us if we're wrong. It's standard stuff. They talk about economic conditions, interest rates, competition, cybersecurity, all the usual suspects. They mention the wars in Ukraine and the Middle East as potential risks, which is a pretty standard thing to say these days since it impacts business and economic conditions in the US and abroad. Alright, let's get to the juicy stuff. They completed a merger with Integrated Financial Holdings. This means they now own Westtown Bank and Trust and Windsor Advantage. So Capital Bancorp is getting bigger. They now operate 4 divisions: Commercial Banking, Capital Bank Home Loans, Open Sky and Windsor Advantage. Their commercial banking division is focused on personalized service, and they're trying to grow deposits through specialized channels like homeowners associations. Capital Bank Home Loans is their residential mortgage platform, and Open Sky provides credit cards to people trying to rebuild their credit. Windsor Advantage helps other banks and credit unions with government-backed loans, specifically SBA and USDA loans, which in turn generates fees for Capital Bancorp. Just remember, these forward-looking statements are only relevant to the time they made them, and they disclaim any obligation to update them. They have a bit over 400 employees, and they pride themselves on being a good place to work, which is good for those employees. They received an outstanding rating in their most recent Community Reinvestment Act evaluation, so they are meeting the credit needs of the communities they serve. They are keeping an eye on potential changes to interchange fees, also known as swipe fees, because they could negatively impact their non-interest income. Now for the fun part, the risk factors. This is where they list everything that could possibly go wrong. Weak economic conditions could hurt the business, no shock there. Bank failures or even rumors of failures could erode customer confidence and cause deposit outflows. They mention they have a significant amount of uninsured deposits, which could be a flight risk. As of the end of 2024, about 43% of their deposits weren't insured, meaning if people panic, that's a lot of money that could disappear fast. They're heavily concentrated in the Washington, D.C. and Baltimore areas. So if the government cuts spending or there's a local economic downturn, they're going to feel it. They are sensitive to what happens in those geographical areas. They might not be able to measure and limit their credit risk adequately, which could lead to, wait for it, unexpected losses. Their allowance for credit losses, or ACL, might not be enough to cover loan losses. Banks keep an allowance for loans they think won't get paid back, but predicting the future, especially when it comes to defaults, is tricky. If the allowance is insufficient, they would need to set aside more money, which would affect their earnings and financial condition. The small to medium-sized businesses they lend to might have trouble repaying their loans. Small businesses are always at risk. Their commercial real estate loan portfolio exposes them to greater credit risks than other types of loans. These loans depend on the property generating enough income. Interest rate hikes could hurt borrowers' ability to repay, while lower rates could lead to increased prepayments. And, of course, their floating rate debt would get pricier as interest rates go up. Cybersecurity breaches could result in the disclosure of confidential information, damaging their reputation, and creating significant legal and financial exposure. This is true for every company that has data. So for the year, net income was $31 million, but when adjusted, which means backing out the merger expenses, a non-recurring debt write-down, and a weird provision on non-performing loans from FH, it comes to about $40 million. They argue that it gives a clearer picture of the ongoing business performance. The net interest margin, which is basically how much money they make on loans compared to what they pay out on deposits, decreased from 6.6% to 6.22%. That means they made a little less on the spread of money. Digging deeper, most of this decrease was in credit card loans. Their normal margin was relatively stable. They charged off, meaning wrote off as uncollectible, $9 million in loans, which is 0.42% of their loan portfolio. The majority of these charge-offs came from the Open Sky credit card portfolio, specifically secured and unsecured cards. Non-interest income increased largely due to the IFAX acquisition, with a significant portion coming from government loan servicing revenue. Non-interest expenses increased, again largely due to the merger-related expenses of $39 million, plus salaries and employee benefits expenses went up. There was also a write-down on an IFH investment that didn't help. Their total assets increased by almost $1 billion, a 44% jump, and portfolio loans excluding mortgages held for sale increased 38%. A lot of this was from the IFH acquisition. Book value per share, a key metric for bank investors, increased from 18 to 21.31 to 21.20, 31.77. So the tangible book value per share, which is the book value less some of the intangible assets, only went up a little from 18.31 to 7 cents. Non-interest income in mortgage banking was up while credit card fees were down. This was attributed to lower interchange fees and other fee income. They said their loan portfolio has not become subject to increasing pressures from deteriorating borrower credit. Stockholders' equity also increased primarily due to the FH acquisition and earnings for the year. The company and the bank are both above the well-capitalized ratios. Remember that $31 million net income number we mentioned at the start? Well, when you adjust it for those one-time items, it's closer to $40 million. There you have it, another filing decoded. So what's the verdict? Capital Bancorp is in a bit of a transitional phase. The merger with IF has boosted their assets and expanded their services, but it's also added complexity and some one-time costs. Their core business seems solid, but they need to watch those uninsured deposits, manage credit risk carefully, and navigate a changing interest rate landscape. It seems the key to their success hinges on integrating IFH smoothly, managing their loan portfolio, and keeping those customers happy, and maybe, just maybe, finding a way to make those filings a little less snooze-worthy. If you found this breakdown helpful, give us a like, leave a comment, and subscribe for more corporate decoding. Until next time.